How to avoid margin calls in Forex. A margin call is a dreaded scenario for any Forex trader, as it signifies that their account balance has fallen below a certain level, forcing them to deposit more funds or liquidate their positions. While it's impossible to completely eliminate the risk of margin calls, there are several effective strategies that traders can employ to minimize their likelihood and protect their trading capital. By the way, if you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. One of the most fundamental steps to avoid margin calls is to fully understand the margin requirements set by your broker. Leverage, which allows traders to control larger positions with a smaller amount of capital, is a double-edged sword. While it can amplify profits, it can also magnify losses, increasing the risk of margin calls. Traders should be mindful of the leverage they use and avoid excessive levels that could put their accounts at risk. A crucial tool for managing risk and preventing margin calls is the stop-loss order. By setting stop-loss orders, traders can automatically close their positions if the price moves against them, limiting their potential losses and preventing them from spiraling out of control. It's essential to place stop-loss orders at a level that is consistent with your risk tolerance and trading strategy. Another key factor in avoiding margin calls is to avoid over-leveraging. Trading with more capital than your account can comfortably support increases the risk of margin calls, as even small price movements can have a significant impact on your equity. It's important to trade within your means and avoid taking on positions that are too large for your account size. Regularly monitoring your account balance and the equity in your positions is essential for identifying potential risks and taking proactive measures. By staying informed about your account's health, you can adjust your trading strategy as needed to avoid margin calls. Diversification is another effective way to reduce the risk of margin calls. By spreading your investments across multiple currency pairs or instruments, you can reduce the impact of losses from any single position. A diversified portfolio can help to cushion the blow if one or more positions experience a downturn. Hedging, a strategy that involves taking opposite positions in related markets to offset potential losses, can also be useful in preventing margin calls. For example, if you're long EUR/USD, you could hedge your position by going short on a related currency pair like GBP/USD. However, it's important to note that hedging can introduce additional complexities and risks, so it should be used with caution. Avoiding trading during periods of high volatility can also help to reduce the risk of margin calls. Market fluctuations can be more pronounced during times of economic uncertainty or major news events, increasing the likelihood of losses and margin calls. Traders should exercise caution and consider reducing their exposure during these periods. Finally, developing a well-defined trading plan is essential for avoiding margin calls and making informed decisions. A trading plan should outline your risk tolerance, investment goals, and trading strategies. By following a disciplined approach and sticking to your plan, you can minimize the risk of impulsive trades that could lead to losses and margin calls. In conclusion, avoiding margin calls requires a combination of risk management strategies, careful planning, and discipline. By understanding margin requirements, using stop-loss orders, avoiding over-leveraging, monitoring your account, diversifying your portfolio, considering hedging, avoiding high volatility, and developing a trading plan, you can significantly reduce your risk of experiencing a margin call and protect your trading capital.